So we will be doing now today this our topic, which is taxation. So we will do some practice questions from taxation, or you can call it IAS 12, which is tax. From BPP kit, we are going to pick up some MCQs, and we'll do those MCQs. Now, before I start this thing, let me tell you what type of questions they will ask you. They will give you some data, and they will ask you two questions. What is the tax expense for the year? This is one question which they may ask you. Or they will ask you that what is the tax liability? This is another question. Or they will ask you what is the deferred tax liability. So these three things typically are there in questions: tax expense for the year, or probably the tax liability, and probably what is the deferred tax liability. Now we discussed before that deferred tax, what it is. We already know our deferred tax concept. I come back to the first one. What is the tax liability? So usually, how do you calculate your tax liability? This is our starting point, because I'm sorry, tax expense. This is our starting point. What is the tax expense? Because many questions, they are for tax expense. So you should understand your tax expense. It typically, in most cases in F7 level, it consists of three elements. Number one is your current year tax. So this is your tax expense. Naturally speaking, whatever is your profit, based on your profit, you calculate your tax, and that is your tax expense. It may have plus minus. I call it under or over. Under or over provision. So under or over provision from the last year. Under over provision from last year. What does that mean? Under over provision from last year means that maybe in last year, when you calculated your tax, like on 31st of December, you estimate your tax expense, and your estimate was like, $1 million. You thought that your tax expense is $1 million. This was your estimate, or you may call it that this is your provision. This is your estimate, or this is your provision. You provided last year. You provided this thing last year, your estimate or your provision. But then what happens? This was previous year. Now this year, when you actually pay the tax, you pay probably the amount came out to be 120,000. So you made an estimate which was 20,000 less. In last year, your tax you recorded less, so you have to pay that. So if there is any under provision, you must be adding it. So let me write down like this: add under provision. So if you have any under provision from the last year, you must be adding it here. So I've got X here, I add here this number. Alternatively, if there was over provision, less over provision. Over provision means that last year you created extra provision. You somehow, you showed extra amount, you showed it more. So if it is over provision, you should subtract it, because last year you already said that I'm going to pay, 1.5 million, but actually it came out to be 120, 1.2. So you provided more. So if you provided more last year, this year your expense should decrease because you paid more last year. You recorded more last year. So this is under over provision you should treat from the last year. And then the last thing which comes in, so this I treat it as one entity, okay? This is like one thing. Either it will be under or over. Both will not happen. Either this will happen or this will happen. If it is under provision, you should add it. If it is over provision, you should subtract it. And then the last thing which comes in, that is deferred tax movement. Deferred tax movement. Deferred tax movement means that you've got your 2011 deferred tax, and you've got 2012 deferred tax. So this is your deferred tax here. So let's suppose in 2011, your deferred tax liability was 100,000. And now in 2012, the current year, I'm calling it current year. In current year, your liability becomes 130,000. So the change in the deferred tax, because your liability is increasing, you should be adding this 30,000 here, okay? This 30,000, the difference, this is called movement in deferred tax. So your deferred tax liability was 100K, now it is 130K. So what you should say, the double entry is debit tax expense, and you say credit deferred tax. So tax expense will be 30,000 added, deferred tax will be 30,000 credit. You book the liability, you book the expense, like for this 30,000. How did it come to the balance sheet 130? It came 130 because of this double entry, and you should be adding it if the movement is positive. Alternatively, it is possible that your deferred tax was 100K, but now it has become just 85,000. So your deferred tax liability has decreased. And how did you decrease it, by the way? I mean, I'm just doing it in Excel. In your accounting books, you don't do it in Excel. There must have been some double entry which has caused this reduction. I mean, when it came down, how did it come down? Because some double entry was made. And what was that double entry? That double entry was debit deferred tax liability. So decreasing the liability, and credit tax expense. So tax expense was credited. So again, if this is the situation, then I should subtract this 15,000. So whatever deferred tax, if deferred tax is increasing, you will increase your tax expense. If deferred tax liability is decreasing, you should be decreasing your tax expense. So your tax expense, essentially, it consists of three things. One is your current year tax.
Sir, one thing.
You see, you can decrease your expense, because maybe in some cases, if you recorded some expense in past more, So you debited it. Now you find out that whatever you did more in past, you have to decrease it. So you credit that expense. I mean, there are many expenses which you are crediting, even as simple as your electricity expense. Let's suppose that you accrued your electricity expense at the end of the month. You made accrual. You said debit electricity expense. I'm just giving you a very simple example, 100. And then you say, credit your accruals, which means your liability is 100. And this is what you did not have an invoice. This was your estimate. You made it on, let's suppose, 31st of January 2019. You thought that it is end of the month, I must record my electricity expense. You check your electricity, that electricity meter, you check the device and you recorded it based on an estimate. But then what will happen that on 5th of February, you will actually receive an invoice. You actually receive an invoice, and your invoice, it says, your invoice says $92. So you book more. What you should say? You should say debit accruals, how much? Liability, which means $8, and credit electricity expense, $8. I'm just decreasing it. So now it is debit 100 and it is credit 8. So you can actually, in fact, credit the expenses. I mean, it does not mean that expenses are always debited. We debit them when they increase. Usually they increase. Like 90% of the times you are making debit to that. But 10% of the times, if there is any reduction in expenses, you can decrease it. Now, how does it happen in here? You know what will happen? Why it decreased? Because your tax base decreased. Probably you have a non-current asset and impairment has happened. Listen, if there is a revaluation, now I'm going back to the topic in detail. If there is a revaluation of non-current asset, probably $50,000. And on this $50,000, you must pay 30% tax. You made a gain. You made a gain of $50,000 and you must pay the tax. But you say that, this is not something which I'm going to pay now. I'm not going to pay this tax now. So this is my deferred tax. This is my deferred tax as a result of revaluation. So what you say debit tax expense, for example, which is 50,000 times 0.3, which is 15,000, let's call it. And you would say credit deferred tax. This is my deferred tax liability. But then what happened? Alternatively, it is possible that there is an impairment of asset. Impairment is the opposite of revaluation. If there is an impairment of asset and by, let's suppose, I don't know, 40,000. So now this is a loss for a business. And you should be getting some reduction in tax benefit. So impairment, when it will happen, it will decrease your deferred tax liability. I mean, you should be getting some benefit, some claim, but you cannot get that claim now. You cannot settle it. It remains in your books as a reduction in deferred tax. What you say, you make a reversal of that entry. You say debit deferred tax expense. I'm sorry, debit deferred tax. This is payable actually. Deferred tax liability. So debit deferred tax liability and credit tax expense. I would say debit deferred tax liability. My deferred tax liability will decrease with 40,000 into 30%, $12,000. And I would say credit my tax expense, $12,000. I mean, when you make upward revaluation, deferred tax liability increases. When you make a downward revaluation, deferred tax liability will decrease. So if you talk about deferred tax liability.
Yeah. And sir, one more thing, in both the cases, we will use.
So this is like, you have to calculate how much is your tax base for the deferred tax. Let's start doing questions. You will understand more. So one thing was current tax. Second thing is under or over provisioning. And third thing is deferred tax movement. Like when you calculate your tax expense will consider these three items. Then we may have to calculate tax liability. We may have to calculate deferred tax liability. Now tax liability and deferred tax liability are two things, because within tax liability, you have current tax plus deferred tax. But in deferred tax liability, you only have deferred tax, which are temporary differences, temporary taxable differences, we call them. Temporary taxable differences in the deferred tax thing. Let's do some question. It will help us to understand better. Let me now just make some space for doing this question. I come to this question. This is in your book, question number 137. Let's read it together. And by the way, before we start reading the question, we should read the requirement, that what do they require us to do. So if I read the requirement, it says that what will be shown as the income tax charge in the statement of profit and loss. So they are asking you tax expense. They are not asking you tax liability. They are asking you tax expense. So I start reading it. The trial balance of Highwood Company at 31st March showed a credit balances of 800,000 on current tax. So within your trial balance, this is a credit balance. Actually, when it is a credit balance, you should consider it that it was an over provision in the previous period. It means that we have over provided. Okay. Credit balance. Debit balance means under provision. Credit balance means over provision, and we should subtract it from your current. It means that last year we calculated $800,000 more. When you have a credit balance, it means that you calculated $800,000 more. So in current year tax calculation, we should be subtracting this amount. 2.6 million on deferred tax. So this is our balance of deferred tax, 2.6 million. A property was revalued during the year, giving rise to deferred tax of 3.75 million. So you revalued some property, and when the revaluation happened, so deferred tax thing, it goes up. This has been included in the deferred tax provision of 6.75 million at 31st March 2006. So what is happening? You had actually 2.6 million deferred tax from the last year and 6.75 million from the current year. So the difference of these two is actually the movement in your deferred tax. But you should be careful that within this difference, some of the difference belongs to property revaluation. This 3.75 is property revaluation. We need to treat it separately. I will show you why. Right now, I'm just explaining you the numbers. And then it says the income tax liability for the year ended 31st March 2006 is estimated at 19.4. So your current year tax is 19.4 million. So we go back to our format, and our format, what did we learn? Let me just somehow create some space here. So we said that we will start with, let me create some space and make it a little bit bigger here. So you have to calculate your tax expense. Your tax expense will be like current year tax, which is 19.4 million. I usually write down like this, 19,400, and I assume that there are 3 zeros on the top. I mean, in your book, sometime the 19.4, they just write down like this. When they say 19.4 million, so if I write down 19.4 like this, I have to put 6 zeros on the top. I don't like to put 6 zeros on the top. I would prefer, and I would advise you also, do 3 zeros on the top and write down it like 19,400. You should remember this format so that you don't get confused. Throughout your exam, you should be using one particular format. This is my current year tax expense. And I know that add, subtract last year. So last year was over provision. So I would say less over provision. How do I know that it is over provision? How do I know that it is over provision? Because it said that it is a credit balance. So you should remember, whenever you have a credit balance, that is a sign of over provisioning. Why it is an over provisioning with credit, I will explain you later. You can just remember it now that if it is credit, it is over provisioning. So that you should be subtracting 800. That is for sure. After that, we need to record the movement of deferred tax. I mean, movement means that what are the changes in deferred tax? Now, you know that your deferred tax this year is 6.75 million. Okay. So 6750, it is 6.75 million. And last year it was 2.6 million. So apparently it looks like to you that your deferred tax has increased by, okay, let me put it like this. I would put it so that you don't get confused. So last year it was 2.6. This year it is 6.7. So it looks like that deferred tax has increased from 2.6 to 6.7. So there is a 4.50 of deferred tax liability. And that should be added. You should be adding it here, 4150, okay? But that would not give you the correct answer. Because in this question, they told us specifically that out of this change, 3.75 million, it belongs to the revaluation of a property. Revaluation of property. Let me now erase everything so that you can see it clearly. It says that a property was revalued during the year, giving rise to a 3.75 million. So revaluation of property is not your current year tax expense. I'm calculating current year tax expense. It is my liability. I don't say that it is not my liability, but it is not my current year tax expense. I cannot write down because property I'm not going to use for 1 year. It cannot be shown as 1 year tax expense. So that 3.5 million I should subtract. This is the total thing. I would show on my balance sheet liability 6.7 million. I'm not arguing on that. What I'm saying that this 3.75 million, it is not my expense for the year. This I should be taking out. So my net result is only 400. So I should be adding my deferred tax movement for the purpose of tax expense. Listen, I'm calculating tax expense for the year, and tax expense for the year, this revaluation of property, it does not belong to only 1 year. So I just took away the impact of that. So 400 is actually the movement in deferred tax without property. I would call it deferred tax calculation or deferred tax working. So you make this thing, 400 comes in here. Now you make a total, and the total is 19,000. This should be your answer. So you should say that your tax expense for the year is 19,000. What you need to, I mean, this actually, this was very obvious. It was clear. This is very obvious. This is clear. Only this 400 thing, because it is possible that students, they may include 4150, that my movement in deferred tax is 4150. If you add 4150, answer would be wrong. You should pay attention that within 4150, some part of that, and in fact, a very significant part of that, it is due to the revaluation of property, which does not come to the tax expense for the year. It remains as a liability. I'm not denying it is not my liability. It is my liability. I will pay it sometime in future when I will sell this property. But as for this year is concerned, my tax expense is only 19,000. Okay, now this 137 is done, a typical tax expense question. Now let's see question number 138, the next one in the series. And let me put it down so that we don't get any distractions. I just drag it somehow. And we see this question, 138. It says that, okay, before we start doing the question, let's first always read the requirement that what do we need to do? What charge or credit for deferred taxation should be recorded? So it does not ask us about the total tax expense. It asks us only about deferred tax, number one. And number two, it says charge or credit. Charge means expense, which means that if the deferred tax is increasing, so that is called tax charge, or maybe a tax credit, which means that your deferred tax liability is decreasing. So when I say charge or credit, it means that there is a possibility that maybe the deferred tax liability is decreasing. If it is decreasing, that is a credit. If it is increasing, that would be called charge. Charge means expense. In the statement of profit or loss for the year to 31st August 2002. Okay, so start reading the question. Astral company purchased an item of plant for $40,000 on 1st September 2001. The plant has an estimated useful life of 5 years and an estimated residual value of 5,000. So residual value 5,000, cost is 40,000. It means that your depreciation should be 35,000. The expense which you should be recording is 35,000 during the life. The plant is depreciated on a straight line basis. On straight line basis, local tax does not allow depreciation as an expense, but a tax allowance of 60% of the cost of the asset can be claimed in the year of purchase and 20% per annum on a reducing balance basis in the following years. Okay, so our internal IFRS thing, financial accounting, we are depreciating it on straight line basis. But your local tax legislation, it says that you can charge 60% of the cost, which means 60% of 40,000 in the first year, and then 20% per year, whatever is remaining, reducing balance 20% in the following years. Now, of course, there is going to be a different amount of depreciation going into the income statement. Like we discussed in previous lesson that we have accounting profit, we have taxable profit. Accounting profit means IFRS income statement. Taxable profit means tax income statement. So in my accounting profit, the IFRS income statement, I will be calculating on straight line basis. And for the tax purposes, there will be a different number. And because the two depreciation amounts will be different, there will be definitely some temporary differences will arise. And those temporary differences will ultimately cancel out each other. But in the current period, they will remain. So they ask you that what is the deferred tax credit or charge for the year ended 31st August 2002? Now, what does that mean? You are buying it on 1st September 2001. You are putting it on 31st August 2002, which means the first year operation. So in first year, how it will make? Now, you have to see that how you are going to charge it. So I start with my first thing, which is my IFRS stuff. So if I'm making my IFRS, or if I call my accounting profit, my accounting profit purposes, how I would record that. For accounting profit purposes, I would say that my cost is 40,000. My residual value is 5,000. So it means that the depreciable amount is 35,000. You call it actually in accounting depreciable amount. Depreciable amount means that the total amount which can be charged as depreciation. But this has to be, life is 5 years. The plant life is, it is given in this question, it is 5 years. So it means that your annual depreciation charge in your accounting profit in your IFRS books should be $7,000. So 7,000 you are charging depreciation in your accounting books, 7,000, 7,000, 7,000 straight for the next 5 years. Now, the second thing is called tax base. Tax base means your textbooks. In your textbooks, your cost of the asset is claimed to be 40,000. And they ask you, they give you, first year it says that, it says local tax law does not allow depreciation as an expense, but a tax allowance. So I got a tax allowance, which means tax allowance you can consider as a depreciation. Your tax allowance in year one, they asked you that, they told you that you can charge as 60%. So it means that I can charge a depreciation of 40,000 into, 60%. Oh, that's a big amount. 24,000 they allow you to charge as, and you can get a tax benefit on that, which is 24,000. Okay, now what will happen? Now you imagine that. So now you know that there is a difference in the amount. You've got 7,000 depreciation here. You've got 24,000 figure here. Now, it definitely is going to give rise to some deferred tax asset or deferred tax liability. Now, how much is that difference? And is it my asset? Is it my liability? Is it going to be a debit or a credit thing? You've got two approaches to do it, whichever suits you. You can think like this, that you have 40,000 of asset. End of year one, you will charge your 7,000 depreciation. So your book value of the asset is called 33,000. This is what you call the book value in your accounting books, the value of the asset. And this is, we call it the tax base. And here you've got 40,000 and you charge a 24,000 depreciation. So here your book value of the asset is 16,000. So the difference, these two, now you've got different tax bases, okay? You've got a difference in the tax base, 33,000 and 16,000. So what you can say that the difference in tax base is 33,000 minus 16,000. So how much it makes me? 33,000 minus 16,000. It gives us 17,000 is the difference in tax base. And your tax rate is 30%. So you just multiply 17,000 multiplied by 30%. It gives you 5,100. So 5,100 is going to be the difference. That is, this will create your deferred tax of 5,100 deferred tax, liability. Why it is liability, I will show you. This is one way of doing this question. Another way of doing this question is that, see, when you put some expenses, according to IFRS, you should be putting $7,000 expense. This is what you wanted to put. But the tax department, they allowed you to put an expense of 24,000. So it means that you will be paying less tax here, because you are showing more expense. When you show more expense, you get tax benefit. How much tax benefit you are getting? I mean, when you put 24,000 as an expense, if you refer to our previous lecture, this 24,000 expense multiplied by 30%, this is the benefit which you are getting. which is 7,200. Whereas if you consider this one, 7,000, so based on 7,000 into 0.3, you should be getting your benefit as, let me correct this formula. I put 2 times this sign, and this one I will just put it into -1. So 2,100 tax benefit you should be receiving, but tax department allows you to receive a benefit of 7,200. The difference of these two numbers, 7,200 minus 2,100, again is 5,100. So there are two ways of doing it. I mean, either you can calculate this number through the tax base. Tax base is 33 and 16. You check the difference and you find out. Or you can, based on your depreciation, and you can get the numbers. Okay, this is the tax benefit I'm getting. This is the tax benefit, okay, which you are claiming. This is what you should be claiming, and this is what you are claiming. So you are actually paying less tax here. If you consider here, so I mean, you are paying less tax because you got 7,200 benefits. So your tax amount is less you are paying, and this will be called your deferred tax liability. It will give rise to a liability thing because you are claiming more benefit now, and you are paying less tax. But in next years you will be paying more tax because next period your depreciation IFRS will be 7,000 every time. But here depreciation expense will become less, and then you have to pay more. So now you are paying actually less tax. 5,100 you are paying less, and this will give rise to your deferred tax liability. You can do this question in two ways. One way is take the book values, like whatever is the book value, it is 17,000 here. I'm sorry, 16,000 here, and 33,000 here. The difference of these two book values, that is the difference in the deferred tax. Number one method. Number two method, you just see that in which period. If I'm showing I'm getting more, I'm putting more depreciation in my textbooks in the current period. So next periods I will have to put less. So it will give rise to a tax liability. Question 139. Again, as we said that first we read the requirement. Identify whether a deferred tax asset or a liability should be recognized on 31st December 2005. So whether it is going to be a deferred tax asset or a liability, and what should be the amount. So let's start reading the question. Isaac and Joseph Company purchased new machinery on 1st January 2005. Dates are important, for $1 million. It has a residual value of 200,000, which means 800,000 will be, the tax benefit will be claimed on 800,000 because we put depreciation on 800,000. Because 1 million asset, residual 200, 800 you will put down in different years. With the useful life deemed to be 8 years. So it looks like that if I do it on straight line basis, I can immediately see that in my IFRS books, I will be charging 100K depreciation every year. Because 1 million is the cost, 200 is residual, 800 I have to depreciate in 8 years, straight line basis. So 100K, 100K, 100K is going to be your IFRS based depreciation, your accounting books, in your accounting profit calculation. Tax allowances of 50% of the cost of the asset can be claimed in the year of purchase. So it means half a million, 50% of 1 million, you can put straight in the year one, as a depreciation is not allowed for tax purposes. The rate of income tax is 30%. Identify whether a deferred tax asset or liability should be recognized and at what amount. Okay. So now what you need to do, very simple thing. If you want to do this question very quickly, you should be seeing that how much depreciation you are going to charge in your textbooks. Within your IFRS books and your textbooks, we have to see. So I would say that my accounting books, I'm going to charge depreciation, which is 100,000, 1 million minus 200,000, the residual value. And because it is a straight line method, I would divide it with 8. It will give me a depreciation of $100,000. So this is my depreciation here. If I see my tax books, tax base, in tax, I would be charging a depreciation allowance, or you call it, you call it, tax allowance. What they are giving you a tax allowance of 50%, and that 50% of tax allowance is 500,000. So here you get a benefit of 30%. So because your tax is 30%, so 100,000 into 0.3, and here you are getting a benefit of 500,000 into 0.3. And the difference of these two, just like we did before, 150 minus 30, it is 120,000. And by the way, this is going to be your liability because you are collecting more benefit. You are paying less tax because you are charging. I mean, if you compare it with your accounting books, you should be getting a benefit of 30, but you are getting a benefit of 150,000. So the difference in these two will ultimately you will have to pay. You are paying less tax now because you are showing more expense than needed. Because the expense which goes into your accounting profit is only 100,000, but in textbooks you are showing expense of $500,000. When you show expense more, you pay your profit becomes less, and you pay less taxes in the current period. But in future you will have to pay for that. So that becomes 120,000 deferred tax liability. This is one way of doing that. The other way of doing was, which we said that we can do it in another way. We can say that our cost was $1 million. Our depreciation was 100,000 in the year one, and let me actually put it minus. And this is my book value. I would call it my net book value was 900,000. So 900,000 net book value comes in my accounting books. In my tax books, my asset was, again, like before, 1 million, but my tax allowance, which I deducted, was $500,000. And when you calculate your base, your tax base becomes as 500,000. So this is your tax base, okay? Tax base of asset, which is 500,000. Now the difference in these two tax bases, the difference, like the difference between 900,000 minus 500,000 is actually 400,000. And 30% of that 400,000, it gives me 120,000. So either I do it like this or I do it like this. Two methods I told you. Calculate the book values. The difference between the book values, will decide your deferred tax amount. Because the book value is more here, so you have a liability. The book value is more in your accounting books, you will have a liability. So you do it in any case, it gives you 120,000, or you calculate the benefits and the difference in benefits, it gives you 120,000. Unfortunately, we do not see an answer 120,000 here. I'm 100% sure that the solution has some problem. Now we stop here and we go back and we see how it was done. But you can consider that answer is 120,000. It is 2 plus 2, 4. There could not be any other alternative.